Amazon just unleashed an absolute financial supernova. Total revenue slammed in at a colossal $181.5 billion, surging 17% year over year. Legacy online stores anchor the volume at $64.3 billion, but the true margin engines are violently accelerating. Third-party seller services rake in $41.6 billion, advertising prints $17.2 billion, and AWS completely crushes a $37.6 billion milestone, exploding at a 28% growth clip. Flowing through the operational pipeline, they extracted $94.1 billion in gross profit, locking in a massive 52% margin. After surgically containing $70.2 billion in operating expenses, heavily fortified by $27.3 billion technology and content budget, they yielded an unprecedented $23.9 billion in operating income. But here is the ultimate financial shockwave. Printing a towering earnings per share of $2.78, Amazon annihilated Wall Street's $1.63 estimate by a terrifying 70%. This propelled total net income to a staggering $30.3 billion, proving this empire is now a flawless, unadulterated cash-printing monopoly. Amazon's revenue engine has completely mutated. The total volume rockets from $116.5 billion in fiscal 22 straight to a staggering $181.5 billion. But the real shockwave lies in the segment compound annual growth rates. Legacy retail is crawling. Online and physical stores are plotting mere 5.9 and 6% CAGRs. The digital engines are cannibalizing everything. Subscriptions lock in 12.4%. Third-party services squeeze the ecosystem at 13.2%. Now, the ultimate margin drivers. AWS surges at a massive 19.6%, and the absolute crown jewel, advertising violently explodes, dominating the entire trajectory with a 21.5% CAGR. This is a ruthless structural pivot from low-margin retail directly into a high-margin digital monopoly. This is the ultimate master blueprint of a trillion-dollar intelligence monopoly. 5 absolute pillars of dominance dictate this empire. First, the AWS engine, generating $37.6 billion in revenue with a historic $14.2 billion operating income, backed by an impenetrable $364 billion contract backlog and an AI revenue run rate ripping past $15 billion. Second, generative AI and silicon. Amazon intentionally vaporizes short-term cash, committing a massive $43.2 billion in capex to build an AI fortress. Their custom silicon prints a $6.6 billion run rate, while Bedrock customer spend surges 170% quarter over quarter, driven by stateful AI agents with 8-hour memory. Third, the core retail machine. North America operating income surged 42% to $8.3 billion, fueled by a $150 billion grocery run rate and over 1 billion lightning-fast deliveries. Fourth, advertising and 3P. A $17.2 billion ad machine crossing the $70 billion trailing 12-month mark, retaining a 60% third-party share while expanding off-platform through Netflix and Comcast. Finally, Project LEO and alliances, locking in a $100 billion Anthropic cloud commitment fueled by an exclusive 5-gigawatt power grid, absorbing a $1 billion headwind to launch a global satellite network by mid-2026. U.S. e-commerce is violently swallowing traditional retail, surging from 13% straight toward 22% of a massive $7.97 trillion total market by 2028. Within this expanding arena, Amazon's grip is tightening, pushing its U.S. e-commerce market share from a flat 34% up to an ironclad 35.7%. Now look at the sheer velocity of the worldwide gross merchandise value. The total transaction volume is exploding to a staggering $830 billion. But the internal composition reveals the true monopoly architecture. First-party retail sales scale to $255 billion, while the third-party marketplace violently overpowers the entire stack, rocketing to an immense $575 billion. Amazon is no longer just a retailer. It is the inescapable toll booth of the global digital economy. Welcome to the era of ruthless profit optimization. The North American engine drives $8.3 billion in operating profit, surging 42%, and expands margins to 9% on $104.1 billion in revenue. International operations flip, yielding $1.4 billion in profit. This exposes a massive operational efficiency gap. Total profits are compounding 4 times faster than raw revenue. Internal grocery dominance is absolute, grabbing the number 2 U.S. spot at a $150 billion volume. They print an explosive 40 times growth multiple in perishables. First-party sales are surging at record post-pandemic rates, causing the third-party share to dip to 60% over recent consecutive quarters after years of steady gains. This volume is fueled by a flawless regionalization strategy, executing 1 billion same-day or overnight deliveries across the national grid. Strategically, Prime Day shifts to June, capturing back-to-school budgets across 21 countries to build an immediate financial buffer against massive AI capex. To fund this empire, Amazon ruthlessly squeezes its partners, implementing 11 structural fee changes and a devastating 1,600% penalty spike. Inbound defect fees hit 60 cents per unit. An average SME moving 40,000 units takes a brutal $10,000 direct hit to pure profit. The global digital advertising market is detonating at a 10.8% compound annual growth rate, tearing straight toward $1.1 trillion by 2029. While the legacy duopoly holds the apex, Amazon is executing a ruthless disruption, violently capturing $79 billion in pure ad spend. They are completely eclipsing the rest of the global tech sector. But the real financial shockwave is retail media. This specific segment is aggressively cannibalizing the U.S. ad market, surging from a 12% share up to 25%, scaling to a massive $110 billion. Within this hyper-lucrative arena, the ecosystem is an absolute slaughter. Amazon maintains an unbreakable, suffocating monopoly, commanding a staggering 77.3% of the entire U.S. retail media space. They leave Walmart starving at a meager 7%, forcing dozens of legacy retailers to bleed over the final remaining scraps. The cloud infrastructure market is an absolute bloodbath, within a massive $129 billion total market, surging 35% year over year. The hierarchy is firmly established. Amazon Web Services commands the absolute apex with a 28% market share, maintaining a massive defensive perimeter against Azure at 21% and Google Cloud at 14%. Tracking the multi-year trajectory lines across the timeline, we witness the historic battle for compute dominance. After a prolonged phase of enterprise optimization, the momentum line for AWS is reigniting its upward trajectory. Fueled by generative AI workloads, AWS isn't just defending its territory, it is solidifying its reign as the undisputed sovereign of global infrastructure. The AI and cloud revolution is operating at a blistering velocity. The AWS compute engine is surging with a 28% year-over-year acceleration, locking in $37.6 billion in quarterly revenue and obliterating records to hit a $150 billion annual run rate. The battle for future enterprise compute is locked inside massive contract vehicles. While Google Cloud holds $462 billion and Azure sits at $392 billion, AWS is rapidly closing the remaining gap, securing a fortified $364 billion in contract backing. This immense scale is driving a historic $14.2 billion profit, pushing operating margins to a breathtaking 37.7%. Underneath this is absolute hardware autonomy. The custom silicon division actively breaks the NVIDIA monopoly, printing a $20 billion revenue run rate with explosive 3-digit year-over-year growth. The upcoming Trainium 3 architecture unleashes a 2 times performance multiplier while slashing energy consumption by 50%. This silicon supremacy directly ignites the generative AI explosion. The AI run rate violently hits 15 billion. Scaling 260 times faster than the original cloud business. The Bedrock platform destroys exclusivity by deploying OpenAI GPT 5.4 and 5.5, while stateful micro-VM agents autonomously execute complex, 8-hour enterprise workflows. Complementing this compute core is a weaponized advertising ecosystem. Surging 24%, ad revenue hits $17.2 billion. Pushing the 12-month run rate past an astonishing $70 billion. Rufus AI transforms intent into instant monetization, driving 20% of users to interact directly with brands. The only friction? A $2.5 billion FTC fine for Prime dark patterns, split into $1.5 billion in refunds and $1 billion in penalties. A mere speed bump for an unstoppable global machine. Amazon's 2030 roadmap is a blueprint for absolute global dominance. The Masterplan begins with a mind-bending financial paradox. Free cash flow is intentionally vaporized, plunging from $25.9 billion down to a mere $1.2 billion. This directly funds an unprecedented $200 billion AI investment, pushing CapEx 4 times higher than 2023 levels. While operating income hits all-time highs, this massive hyperscaler spending creates an impenetrable capital barrier, entirely eliminating all Tier 2 competition. Project Kuiper executes commercial orbit to conquer the skies. Over 300 satellites are deployed across 11 missions by April 2026. Armed with FCC approval for 7,727 satellites, they're building a direct rival to Starlink, locking in global B2B connectivity contract for Delta Airlines, JetBlue, and Vodafone by 2028. In the physical realm, the healthcare ecosystem expands into 4,500 cities, integrating same-day pharmacy and GLP-1 treatments with One Medical by late 2026. Zook's robot axis surpassed 2 million miles, integrating with Uber across Vegas and Miami. The Amazon Bio-Discovery platform compresses antibody design time from months down to mere weeks. The only friction is the Nessie legal battle, facing FTC lawsuits over an algorithmic pricing monopoly. But this is completely eclipsed by a monumental opportunity. As Alphabet faces severe antitrust breakups, Amazon advertising is perfectly positioned as the ultimate safe haven to capture fleeing global ad spend. To forge a global war machine, you must exercise surgical cost discipline. The total operating expense volume executes a relentless expansion, scaling from $46.2 billion to a massive $70.2 billion. But listen to the structural compound annual growth rates. General and administrative costs are completely frozen at a 0% CAGR, while marketing is strictly contained at just a 5.5% compound growth. Why? Because Amazon is aggressively funneling capital into its true weapons. The physical fulfillment network compounds at 9.9% to absorb $29.6 billion, while the technology and content engine violently surges with a 16.5% CAGR, hitting $27.3 billion to secure an impenetrable infrastructure moat. This is the exact profitability shock that forced the financial elite to rewrite their valuation models. The revenue engine maintains a steady, compounding expansion from $116.4 billion to $181.5 billion. But look at the net income margin trajectory. For years, it hovered in the volatile 0 to 3% zone, even bleeding negative capital. But entering fiscal 26, the margin triggers an absolute financial earthquake, breaking into a fierce vertical ascent. Smashing straight past 12%, it detonates at a staggering 17%, printing an unprecedented $30.3 billion in net income. The era of missed targets is completely obliterated. The execution timeline pitches reported revenue directly against Wall Street estimates. Quarter after quarter, Amazon systematically underestimates and violently overdelivers. Notice the distinct seasonal spikes, constantly establishing higher baseline thresholds. They just vaporized the $177.3 billion consensus by printing an immense $181.5 billion. This exact compounding momentum is aggressively accelerating, fueled by the strategic shift of Prime Day into June to capture early budgets. The immediate next phase rockets straight into the $195 billion tier, perfectly setting up a staggering $241 billion stratosphere for the upcoming holiday cycle. This is the absolute definition of a pure earnings decoupling. Historically, the earnings per share demonstrated a steady, predictable compounding trajectory against analyst consensus. But the first quarter of fiscal 2026 shattered every known paradigm in corporate finance. Analysts conservatively modeled $1.63, but Amazon unleashed a towering $2.78, executing an astronomical 70% beat. To be ruthlessly accurate, this headline number is heavily amplified by a $16.8 billion unrealized paper gain from the Anthropic AI investment. Yet even stripping away that paper profit, the core adjusted operational earnings still completely overpowered Wall Street estimates. The underlying leverage from custom silicon and automated logistics is violently annihilating forecasts, proving this ecosystem is the ultimate cash-printing monopoly. The broader market is an absolute capitulation. The historic price trajectory executes a fierce vertical breakout from a prolonged consolidation phase, smashing past the $272 threshold. Despite temporary market fears over massive capital expenditures, institutional analysts are firmly establishing an average target of $307.78, projecting a massive 12.79% expansion. But the Ultra Bulls are charging much harder. They set a maximum strike price of $370 per share, demanding a staggering 35.6% premium. Even the absolute minimum baseline is heavily defended at $207. The consensus rating gauge is pinned to maximum conviction out of 73 analysts issuing guidance. An overwhelming 58 are screaming strong buy, reinforced by 9 buys and absolutely 0 sells across the board. The institutional elite are aggressively pricing in unchecked dominance as Amazon forges the global AI infrastructure. A quick reminder: the views expressed in this video reflect opinions at the time of publication and are based on sources believed to be reliable. This content is strictly for informational purposes only and does not constitute investment advice. If this deep dive gave you the edge, hit like, subscribe, and drop your verdict in the comments. Thanks for watching, and see you on the next one.